Hey guys, what's up? I'm Erin and welcome back to the channel. If you've been a disciplined saver and investor, you might be in the very fortunate position that you're not only secure in your financial future, but you're also in the position where you can help the next generation. Maybe that means helping your child buy their first home. Maybe it means covering the tuition for your grandchildren, or just giving them a head start with investing. It's one of the greatest rewards of financial success, the ability to give while you're here to see the impact. But gifting does come with its own set of IRS rules, exceptions, and a little bit of paperwork. So today we're going to break it all down so you completely understand. We'll look at how the annual and lifetime limits work in 2025, the special exceptions and when they kick in, what counts as a gift and what doesn't, and we'll walk through a real-world example. And stick around until the end because I'll go over some common questions that don't always get answered with the most clarity. So with that, let's dive in. In 2025, the annual gift tax exclusion is $19,000 per recipient. That means you can give up to $19,000 to as many people as you wish, whether that is children, grandchildren, friends, all without any reporting. And if you're married, you and your spouse can combine the exclusion. That means you can give $38,000 per person per year. This is called gift splitting. Here's the key. This is a per recipient rule. So if you have 3 children, you could give each of them $19,000 or $57,000. And if you're married, you and your spouse can double that amount. And all of this can be done without touching your lifetime exemption. And there's one more thing to hold on to. These numbers are indexed for inflation. So while they're $19,000 per person in 2025, they're going to increase over time. Now, what if you want to give more? Well, that's where the lifetime gift exemption comes in. In 2025, the exemption is $13.99 million per individual or $27.98 million per couple. Any amount you give in excess of the annual exemption just gets applied to the lifetime exemption. So importantly, you're never going to be paying tax unless you've used up your entire lifetime exemption. So that also means that 99.99% of people are never actually going to pay gift tax. The only consequence is filing IRS Form 709 to report the gift. You only owe gift tax if your lifetime gifts per person exceed these very high thresholds, at which point the IRS does levy a 40% gift tax. But the good news is not only are the annual limits adjusted for inflation, so too are the lifetime limits. Just a handful of years ago, they were around $11 million. Today, they sit around $14 million per person. And under the One Big Beautiful Bill, which was passed this year in 2025, the exemption will jump to $15 million per individual or $30 million per couple starting in January 1st, 2026. And those inflation adjustments will continue from there. And here's where people sometimes get confused. The annual exclusion and the lifetime exclusion aren't either or buckets. They work together, kind of in layers. Think of it like this. Every year, the first slice of your giving is covered by the annual exclusion, $19,000 per recipient or $38,000 if you're married and splitting gifts. That's the free pass. If you decide to give more than that, the extra doesn't trigger an immediate tax bill. It simply starts reducing your lifetime exemption, which is just under $14 million in 2025. So in practice, you can give both, your annual exclusion plus however much of that lifetime exemption you want to tap into. Let's put some numbers to it. Let's say you want to give your child $50,000. You can give $19,000 and that would apply towards your annual limit. The remaining $31,000 would apply to your lifetime gifting limit. The only consequence at this point would be filing that IRS form. There's no gift tax due. And there is an important nuance to point out here. The annual exclusion is sort of a use it or lose it feature. Let's say you didn't gift anything back in 2024. You can't retroactively try to apply a gift to 2024, and you can't preemptively try to give a gift for 2026, just being that it's year 2025. The only time the annual limit applies is for that specific year. You can't go forward or go backward trying to use different years' annual limits. So for most families, this means you can give very generously, whether that is wanting to help your child with a down payment on a home, to start a business, or even help to fund a wedding. The IRS just wants a system to track total lifetime gifts. They're not trying to discourage those gifts or punish it. Now, what counts as a gift? A gift is any transfer where you don't receive full value in return. Giving cash, that's a gift. Paying off your child's credit card, that's a gift. Buying a car, titling it in their name, that's a gift. Helping them with a down payment on a mortgage, but paying the mortgage lender directly, that's still a gift. So in other words, it doesn't matter if the money passes directly to your child through their hands or to a third party. If it benefits them, that's a gift. In some cases, it is just simpler and a smoother transaction to pay the lender, the title company, or the broker directly rather than giving the money to your child to give to this third party. But from the IRS perspective, it is still considered a gift. But of course, not everything counts as a gift. There are some really important exceptions you should know about. These are essentially carve-outs where the IRS says, no, that doesn't count as a gift. Number one is tuition. If you pay the tuition directly to the educational institution, it's unlimited and never treated as a gift. But note that this only applies to tuition. It doesn't include room and board, books, or other school fees. Medical expenses. If you pay the doctor, hospital, or even the insurance company directly for someone's medical care, that is not considered a gift. Gifts to your U.S. citizen spouse. You can give an unlimited amount to your spouse if they are a U.S. citizen. If they're not a U.S. citizen, there is an annual limit, and in 2025, that is $190,000 per year. Gifts to qualified charities. Donations to qualified charities are not treated as gifts for tax purposes and may even qualify you for a deduction. And finally, political contributions. Gifts to political organizations are not considered taxable gifts. All of these categories are unlimited and they do not affect your annual limit or your lifetime exclusion. So if you're a grandparent who wants to help your granddaughter with her tuition for college, simply write that check directly to the institution and it doesn't affect your gifting limits at all. Let's take the classic example. Mom wants to help out with a $100,000 down payment on her child's home. Here's exactly how that would play out. The first $19,000 is covered under the annual exclusion. The remaining $81,000 is over that limit, so it reduces her lifetime exemption. She'll need to file Form 709 to report it, but no taxes are owed unless she's already given away more than her $13.99 million for her lifetime. Now, if your mom is married and she and your dad want to split the gift, here's how it might work. Together, they can exclude $38,000 right away. That leaves $62,000 to apply against the lifetime exemption. And for reporting purposes, that $62,000 gets split between them. So $31,000 is applied against each spouse's lifetime exemption. One of the simplest ways to stretch your giving power is by using calendar timing to your advantage. Remember, the annual exclusion resets every January 1st, so you don't get to use a one-time annual exemption of $19,000. You get a fresh $19,000 or more because it's indexed for inflation every single year. So let's say you want to help your child with a big purchase like a down payment for a home, but you don't want to give all of this money at once. You could give $19,000 in December and then turn around and give another $19,000 in January, just a few weeks later. Now you've transferred $38,000 almost back to back, and you didn't even touch your lifetime exemption. And if you're married and using gift splitting, that number could jump to $76,000 over that same window. The point is, with a little creativity with your timing, you can maximize how much you pass along without ever touching your lifetime gift exemption. And this can make a big difference when it comes to helping with big purchases. At the end of the day, here's the key takeaway. For most families, it isn't about writing checks to the IRS. It's just about a little paperwork and planning. So unless you're the ultra wealthy, you're not going to be paying gift tax. The IRS rules were really designed to track large transfers against your lifetime exemption, not to penalize you for helping your kids or your grandkids. So don't let the words gift tax scare you. For practically everyone, it's just about knowing the rules and which form to file if you exceed the annual limit. And beyond that, just enjoy the position you're in being able to help others. Let's go over some common gifting questions that come up that we haven't really covered in the main video. Do I have to report gifts or pay taxes on gifts I receive? No, the recipient never reports the gift as income, nor do they pay taxes on it. The responsibility lies on the donor. If the gift is over the annual exclusion, $19,000 in 2025, the donor simply files Form 709 with the IRS. And again, unless they've already exceeded their lifetime gifts to you, $13.99 million in 2025, no gift tax applies. Does that, fill in the blank on whatever that is, really count as a gift? This is one of the most common questions I hear. Parents asking things like, if I pay for my child's wedding, or I pay for a big family vacation, or I buy my child a car, does that really count as a gift? Technically, yes. The IRS defines gift very broadly. Anytime you transfer money or value to someone else without receiving equal value in return. So if a parent pays $40,000 directly to a wedding venue, or they pay for a big family vacation, or they buy their child a car, anything that exceeds that annual limit is supposed to be filed on Form 709 and reported against the lifetime exclusion. But in practice, most families don't treat it that way. Instead, maybe parents pay a vendor directly and then see it as covering an event in the case of a wedding. And they never file Form 709 with the IRS. And honestly, the IRS doesn't really have a way of tracking these payments. So unless you're dealing with a very large estate where gifting strategies are being used to reduce estate taxes, one-off expenses like weddings or vacations are unlikely to ever raise a red flag. The key takeaway here is that by the book, yes, these situations or events are gifts, but the vast majority of families do not treat them that way, and enforcement outside of truly high net worth estates is very rare. What if my parents buy me a car but keep the title in their name? That is not seen as a gift. So long as the car is titled in their name, it is their asset. It becomes a gift when the title is transferred to your name, and at which point it would be the value of the vehicle at that time. What if I pay off my child's debt, like a credit card? This would be seen as a gift. Even if you pay the lender directly, the IRS would look at this as a gift. But depending on the amount, again, a lot of parents wouldn't report this. What happens if I gift stock instead of cash? If you give stock, the value of the stock or mutual funds on that day is what is treated as a gift. But there is one important thing to hold on to. The person you're gifting it to also inherits your original purchase price as their cost basis. Let's say you bought Apple when it was $50 a share, and it was worth $200 a share when you gifted it. Your child's cost basis is still $50. That means when they sell, they owe capital gains tax on all of that increase from $50 up to the sale price. But here's the wrinkle. If instead of gifting this stock during your lifetime, you leave it to your child when you pass away, the rules change. These type of assets, when inherited at the time of death, get a step up in basis. So the value for your child or their cost basis would be the value on the date of death. In this example, if Apple is worth $500 when you pass, your child's new cost basis is $500. If they sell right away, there's no capital gains tax at all. That's why in a lot of situations, it can make sense to hold on to highly appreciated assets and pass them on through your estate rather than during your lifetime. What if the donor passes away after making large gifts? When someone dies, the IRS adds up two things: the gifts they made during life and the value of their estate. Gifts above the annual limit reduce what's left of their estate exemption. But here's the important point. As long as the total of these two, the lifetime gifts and the estate, fall under the lifetime threshold, there is no estate tax or federal gift tax due. So for most families, this is not a concern. There's another strategy worth knowing about if you're thinking about large transfers, and that's using an intra-family loan. Here's how it works. Instead of gifting your child a lump sum, you can loan them the money. The IRS sets a minimum interest rate each month called the applicable federal rate, AFR. These rates are usually very low compared to what a bank would charge, and as long as you charge at least that rate and document it, it's considered a real loan and not a gift. Now here's where things get interesting. Over time, you can forgive portions of that loan using your annual exclusion. For 2025, that means you could forgive $19,000, or if you're married and splitting gifts, that would be $38,000. So effectively, you would be helping to chip away at this loan balance without ever touching your lifetime exemption. Let's take an example. Say you loan your child $200,000 to buy a home. You set it up with the IRS required interest rate and a payment schedule. Each year, you forgive $19,000 of the balance. Over a decade, you could forgive nearly $200,000 tax-free, and the IRS sees it as a legitimate loan gradually being forgiven under the annual exclusion. This approach does require paperwork and consistency. It does have to be a documented loan. You do have to charge the AFR interest rate, and you do have to have payments over time. But when done right, it can be a smart way to help with big expenses without ever touching your lifetime exemption. Here's the bottom line. If you've worked hard, saved diligently, and invested wisely, reaching the point where you can help your kids or your grandkids financially is a true blessing. So whether that's a down payment on a home or tuition for college or simply giving your children a financial head start, gifting is one of those meaningful ways where you can really see your money make a difference in real time. The rules can feel complex, but for most people, what it boils down to is pay attention to the annual exclusion, file Form 709 with the IRS if you go above it, and then just know that the lifetime exemption is so large, it will likely never affect you. You'll never pay gift tax. So what are your thoughts on gifting? Leave them in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. And then beyond that, it's just being fortunate and, not fortunate. Sorry. Just say grateful. I don't know. Giving cash, that's a gift. I'm trying cash, credit card, car, home. I want to say all of those. For most families, sorry about the hands. I know, it's a problem, but still. Buying a car, titling it in their name, it did make me feel better when I was with the money guys, and I was like, I'm sorry I moved my hand a lot. Bo was like, well, I've backhanded Brian like 5 times in our conversation. So I think it's just a thing on YouTube. It does actually help keep people watching the video if you move your hands. So the IRS sets a minimum interest rate each month called the applicable. I never realized how hard it is to talk until I'm on camera. In life, I swear I talk so well.